Welcome back, everyone. So let's talk about the U.S. economy because right now it is sending some seriously mixed signals. It honestly feels like we're in a mystery novel with clues pointing in every possible direction. Today, we're going to play detective and try to figure out what is really going on.
I mean, just look at this past week in the market. We had days where stocks rallied, everything's green, but the week as a whole, it finished in the red for all the major indices. And yet, all of this is happening inside a bull market that's been running for nearly 3 years. So what on earth is actually happening here?
And that really is the billion-dollar question, isn't it? Is the foundation solid, or are we starting to see some major cracks appear? To figure that out, we have to look past the headlines and really diagnose the powerful and often contradictory forces that are pulling this economy in different directions.
Okay, first up, the American consumer. For the last couple of years, consumer spending has been the absolute bedrock of this economy. It's been incredibly resilient. But if you look just a little bit closer, that engine is starting to show some pretty serious cracks.
Now, on the surface, the data looks fantastic. Personal income and spending for August both came in hotter than anyone expected. In fact, get this, over the last 2 years, we've only had 4 months where spending actually went down. This strength is literally what has kept the entire economy humming along.
But here's the thing. Who is actually doing all this spending? Is this strength spread out evenly across the whole population? Well, the data suggests a very different and honestly a much more divided story.
We're seeing what a lot of analysts are calling a K-shaped reality, and it's a perfect description of this divide. Think about the letter K. The top 20% of households are seeing their fortunes rise. That's the top arm of the K going up. Meanwhile, the bottom 80%, they're stagnating or even falling behind, and that's the bottom arm of the K pointing down.
And this isn't just some abstract theory. You can see it clear as day in the wealth data from the Federal Reserve. A staggering 67%, two-thirds of all wealth in the country, is held by the top 10% of households. So here's the crucial takeaway. That resilient consumer spending we just saw, yeah, it's largely being propped up by a very small, very wealthy slice of the population.
All right, so on top of this big consumer divide, there's another major pressure point that's been building: tariffs. And while they've been in the news for a while now, their real economic pain, well, it might not even hit us yet.
You see, economic research shows that the full effect of tariffs can take anywhere from 6 to 18 months to really filter through the economy. With the new wave of tariffs just hitting in August, we are only at the very, very beginning. The biggest price impacts are still ahead of us, and they're expected to build through the end of this year and well into next.
And you know what? Consumers are already feeling the anxiety. In recent sentiment surveys, 34% of people, that's more than a third, spontaneously brought up tariffs as a major concern for their finances. They're already starting to notice the hit to their wallets, even if the worst is still yet to come.
And what about the whole stated goal of tariffs? Bringing manufacturing jobs back to the U.S. Well, analysts like Oppenheimer's Brian Nagel are, let's just say, deeply skeptical. He actually calls the idea laughable, suggesting that manufacturers are just moving production to other low-cost countries, not back here, which means the main effect we're all going to feel is just higher prices.
So, we've got a divided consumer and this looming tariff pain. Why in the world is the stock market holding up so well? Well, the answer comes down to one thing: a massive trillion-dollar bet that is fueling incredible optimism: artificial intelligence. Let's be perfectly clear, the AI build-out is the primary engine of this bull market right now. Big tech and all the AI-related stocks are just soaring as trillions of dollars are poured into building out the infrastructure, everything from data centers to chips. For investors, this has become the main story, and it's overpowering a lot of the other economic worries.
But, and this is a big but, not everyone is convinced this spending spree is going to end well for everybody. The well-known investor David Einhorn recently sounded a warning, reminding us all that in a gold rush, not every prospector actually finds gold. He argues that with trillions being invested, it's just inevitable that not every company is going to see a return.
And that return on investment? It's still a long way off. Most analysts will tell you that the actual monetization of AI is probably several quarters out. I mean, there's a long road from building the infrastructure to companies adopting it, then to figuring out how to actually make money from it, and finally, turning a real profit. Investors have been patient so far, but you better believe they're eventually going to want to see the money.
And finally, as if all that wasn't enough, there's a political wildcard that could just throw a giant wrench into everything: the looming threat of a U.S. government shutdown.
Yep,
As we speak, Washington is absolutely barreling towards a funding deadline. And if they don't reach a deal, non-essential government services could shut down as soon as next week. And that would create this huge cloud of uncertainty over the entire economy.
Now you might be thinking, haven't we seen this movie before? And you're right. Historically, the market has often just shrugged off shutdowns. In fact, during the last 4, the S&P 500 actually climbed. But this time, there's a really sneaky hidden risk. A shutdown could delay the release of critical economic data. I'm talking about things like the super important monthly jobs report. Without that data, the Federal Reserve, Wall Street, everyone would essentially be flying blind.
And that, right there, is the real danger. It's not really about the shutdown's direct economic impact, which is often temporary anyway. It's all about the uncertainty it creates. Because markets can handle risk, they can price it in, but they cannot price the unknown. And a total data blackout, that is the ultimate unknown.
So there you have it. You've got a K-shaped consumer, the slow burn pain from tariffs, a massive and speculative boom in AI, and a political showdown brewing in Washington. 4 incredibly powerful forces, all pulling the economy in completely different directions. The big question now is, which one of these forces is going to win out and decide where we all go from here?